Earnings in focus. Dow component Disney set to report its quarter after the closing bell tonight. It comes after the stock touched an annual high in yesterday's trading session. Joining us now is CFRA research media and entertainment analyst Tuna Amobi. Tuna, good to see you.
Thank you, Maria.
Your expectations for Disney tonight?
I think investors are going to be looking for a number of things. First is an update on the ESPN Plus, which launched in the spring. I think that's going to be critically important to get a sense of how Disney is approaching its direct-to-consumer strategy ahead of the launch of the Disney branded offerings. And then we know that the parks business is in a momentum across the world, so that segment should also have some spectacular results. But arguably, I think the highlights are going to be provided by the studio division, right? So you've got Avengers Infinity War, to over $2 billion global box office. That's going to be a major driver, and also Incredibles 2. But beyond the fundamentals, Maria, I think there's also going to be an intense focus on the back and forth bidding war with Sky. We expect Fox to make some type of announcement that could counter the offer that Comcast has on the table. And of course, Disney, which already has an agreement to acquire Fox, has a lot of say in what's going to transpire. So there's a lot of moving parts in the earnings that could be of potential interest for investors.
M&A has really been a big key for the media industry in general for quite some time now. As disruption occurs within the industry between Netflix and Amazon entering the space and everyone kind of trying to get direct to consumer. We saw AT&T, the Justice Department, is appealing that merger. There's questions about Sinclair and Tribune. The FCC is coming in saying that needs to go to a hearing. How do you see M&A transpiring over the next 6 months? Is it still going to be as heated of an M&A market for the media space? Yeah,
Lisa, I'm sorry, Lindsay, we just published, as you know, an in-house piece looking at that very topic as to the M&A sentiment in the wake of FCC's decision on the Time Warner Tribune Sinclair. So we know that the floodgates were supposed to be open after the court's ruling, but now you've got the Justice Department challenging the AT&T and Time Warner. The parties are still moving ahead with that transactions. FCC comes out and sends the Sinclair Tribune deal to administrative review. That being said, we still think the prevailing sentiment from an M&A is cautiously positive. There's still a quest for economies of scale. We think the Disney Fox, transaction and potentially the Sky bid that's still going on is going to help to fuel that sentiment.
More deals. But one of the top stories in the Journal today, the Justice Department argues that a judge ignored fundamental principles of economics in allowing the AT&T Time Warner deal to go through. Is there still a chance to block this thing?
Well, the AT&T Time Warner's response was you don't get do-overs. If there was something that was done improperly, then maybe you can go take it through appeal, but the case has already been tried, right?
Yeah, I don't think there's going to be a do-over, to your point. Right now it's pretty slim that we're going to, there's any way to walk back that transaction. I think, caution is what that government challenge has introduced some type of uncertainties. But all being said, I don't think there's any precedent that would roll back.
Tuna, what's the bigger picture behind all this deal activity that we're seeing in the media right now? Put us in the minds of the CEOs that are directing the bidding for Sky, bidding for Fox, bidding for Time Warner. What is it that they're trying to achieve with all this activity?
Yeah, because you've got Netflix there, right? And they're willing to spend, upwards of $14 billion or something next year on original content. Mm-hmm. The details are unclear in terms of how Disney responds, but most expect Disney's answer to Netflix to be unveiled next year. So, as John said, characterize the environment for us and the backdrop.
So there's a couple of potential underlying themes that are driving this interest. The one that recurs quite often is scale, right? So I think scale has been one of the primary strategic justifications for a lot of the deals that we've seen lately, whether it's the Comcast, Disney, Fox, or in fact, this Discovery and Script networks. Beyond that, I think direct-to-consumer, there's this paradigm shift where I think more content that you can have in the pipeline, the more compelling a value proposition you can make, which is a big reason why we see Disney so bent on acquiring Fox to be able to bolster that offering. I think the consumer is shifting, the traditional audiences are falling and migrating. The media companies want to follow them to where the consumers are going. And then you look at the international implications for that. Comcast, for example, has less than 10% of revenues coming from international markets. Sky offers potentially a platform to raise that revenue to a quarter. So cross-border deals, a company like Sky, in addition to being an established, a satellite television provider, is also a major content provider in its own right. The more content you can bring to the table, the more that you can make a case to investors why you will be one of the potential winners in this shifting paradigm, and the more that the investors are willing, frankly, to accord a higher valuation.
You still have a strong buy on Disney, right?
We do.
All right, going into the numbers, strong buy. Tuna, good to see you.
Thank you very much.
Thank you so much.
Appreciate it.
Tuna Amobi joining us there.